Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. US and Chinese representatives meet to see if the two countries can avoid a full-fledged trade war. Jerome Powell reiterates that the US Federal Reserve is not on a preset course, says it's open to rate pauses if the situation so warrants. A group of ministers has allowed Kerala to levy a 1% disaster cess on goods and services in the state. The proposal will be put before the GST Council on January 10th. And Jet Airways lenders lay down a January 21st deadline for promoter Naresh Goyal to submit a revival plan. Well, Powell's comment did cheer the markets. Frankly, just take a look at all that happened in the world, and there was a lot of green on the screen. He allayed market concerns that the Federal Reserve's policy could derail economic expansion. At a panel discussion on Friday, he signaled that the central bank is open to pause rate hikes if the financial conditions so warrant.
I think the markets are pricing in downside risks is what I think they're doing. And I think they're obviously well ahead of the data, particularly if you look at this morning's labor market data and the other data that I cited. So markets are expressing concerns, again, about global growth in particular. I think that's becoming the main focus, and trade negotiations, which are related to that. And I'll just say that we're listening carefully to that. We're listening with, sensitively to the message that markets are sending. And we're going to be taking those downside risks into account as we make policy going forward. We will be prepared to adjust policy quickly and flexibly, and to use all of our tools to support the economy, should that be appropriate, to keep the expansion on track, to keep the labor market strong, and to keep inflation near 2%. We're hearing a lot from different groups of people about the role that the balance sheet normalization may be playing in the markets. I think we are of the view that what really happens mechanically when our securities mature is Treasury issues a comparable amount of securities, but they do so across the yield curve. The amounts are not that big. They haven't been that big compared to the issuance Treasury is already undertaking. So we don't believe that our issuance is an important part of the story of the market turbulence that began in the fourth quarter last year. But I'll say again, if we reached a different conclusion, we wouldn't hesitate to make a change. If we came to the view that the balance sheet normalization plan or any other aspect of normalization was part of the problem, we wouldn't hesitate to make a change.
Well, that's cheered the world markets for sure. It did cheer the US markets, certainly, in Friday's session. It's been a wild, volatile, seemingly volatile setup for the US markets, but they were down on Thursday. They were up and about in Friday's session. Very strong moves for the US markets in Friday's trade. And frankly, if you look at this, it's been the nature of the US markets the last at least a month and a half, wherein the markets have had significantly high moves. But strangely, while we may think that they are up 3%, down 3%, and therefore are very volatile, volatility by itself has actually come off quite rapidly for the US markets. That white line that you see, which runs through the graphs or runs through the bar charts, shows that how volatility had picked up, and in the last few days, it's actually ebbed off. And this is despite how the last few days, as I said, have been moves which are northwards of 2% on almost every single given day. So the world markets and the US markets very, very active the last few days. World markets are taking cues from what the mother market did in Friday's session. So if you look at the Asian screen right now, it's a tinge of green across the board. We have green coming on the screen, Nikkei about 3% higher, Hang Seng about 1% higher, the SGX Nifty too indicating about 1% higher, and this is despite how the positions looked in Friday's session. So it's not a bad move for the world markets as well. Commodities have bounced back, metals in particular, because China has cut the bank reserve requirement, and the talks of the new trade talks with the US also spurred some of the commodities higher in trade. Almost all the metal names bounced back today. In fact, watch out for some of these commodity-based names. The Vedantas, Hindalcos of the world, they could all rise in the session today. Crude moved higher as well. Again, I reckon in part due to the trade talk, and then there were some supply cuts which should boost oil prices as well. So oil too has edged marginally higher in trade. I don't think it'll hamper India too much today because the world is just so active that we'll still start off in the green despite the fact that NYMEX and crude and NYMEX and Brent have both edged higher. But the question mark only is that what does all of this do to the markets? We'll have a start in the green, but frankly, I think it's been very futile to try and preempt what the markets will do on any given day. On most cases, as we speak to our trader friends as well on the shows, stop losses have gotten hit because the markets have turned around the very next day. So I'll refrain from really talking about what the positions are looking like and therefore what the markets could do. Don't want to get into the prediction game, especially not in a scenario as volatile as this. However, there are some stocks that could be active in the session today, and I think we should try and monitor some of those. So Titan, I think the commentary from Triton for the Q3 update was very strong. They've spoken about how there is good growth momentum across businesses, how there are strong same-store sales growth in the jewelry business, which is the main business for them, and the high marketing spends might weigh in on the watch business margins, but they're still sanguine about the prospects there too. But essentially, jewelry looking strong, growth momentum looking strong. This could well mean that there could be a positive reaction on Titan today. Some of the stocks are out of the additional surveillance mechanism. I've chosen 2 or 3 which I thought could react marginally positive. So watch out for these names. Could have some reactions in these names in the session today. Jet is running a race against time. Lenders have given time till the month end for the revival plan to be submitted. That's about 23 days, and that's too short really. But let's wait and watch what the impact on Jet Airways could be. I don't know if there will be a bit of a big reaction on this one or no, but it's an important stock to monitor in the session today. There could be a reaction on Growth Finance because both Mint and Times of India are reporting that Bandhan Bank may acquire Growth Finance in a share swap deal as early as today. An announcement might come in. I think that's what the reports are saying. Let's see. If not Bandhan Bank really, but Growth Finance is the one that could be active. So we'll watch out for this one as well. And lastly, a couple of names. One, Sobha. The Q3 guidance was a bit muted. It's not that real estate stocks have set the stage on fire and therefore this will be a big disappointment. As I said, Sobha actually ended the day before yesterday about 3.5% lower. But let's see if there's some further downside here. ONGC, routine discovery, but a large one is what they are saying from OVL. Let's see if ONGC has a bit of an impact today or no. But 2 or 3 or 4 names that could have big reactions in the session today. And the metal names, you need to watch out for them. Watch out for ITC as well, because of the disaster cess, which was expected to be pan-India, but will not happen pan-India and only in the state of Kerala. Maybe this one could react as well. However, let's tell you what's lined up on First Word today. It's a collection of the top editorial stories that we bring to you. Two of the world's most powerful central bankers have shown their policies are not set on a preset course. So will that be enough to revive asset class across the spectrum? We ask Mark To of Fung Financial Services about the same. 2018 was not as volatile as one makes it out to be. S. Kannan explains why we say so. Legacy and brand name alone can't see a stock through tough times. Darshan tells us why. Sajid lists out the top and worst portfolio managers of 2018. And Naresh Goyal has a 3-week window to come up with a bailout plan for Jet Airways. Vishwanath Nair takes us through those details. The latest data indicating a slowdown in the world's second largest economy and the annual cash crunch ahead of the Chinese New Year just around the corner. The People's Bank announced a 100 basis points cut to the required reserve ratio. To discuss the impact of this on Asian equities and the commodity markets more importantly, let's get in Mark To. He's Managing Director of Asset Management and Head of Research at Fung Financial Services Group. Joins us right now on the phone line from Hong Kong. Mark, good having you. Thanks much for joining in. Do you expect more policy support from China, and could this just be a start of that?
Well, I think what mainland China's authorities is now doing is very important because it has the positive impact upon the market with the expectations that the policymakers are really concerned about the potential economic slowdown, both from the inside internal factors as well as from the outside external factors like the Fed or the Trump, the trade war concern, something like that. So at this moment, the market in general has a very positive impact, and I think that may sustain for a while, maybe for the coming few weeks, because we can see that we are going to have the Chinese New Year not long time soon. So I think the overall sentiment is really improved, especially because the Fed chair actually has some kind of a dovish comments combined with a strong economic data. So it is a very good condition for the market to have some kind of a rebound. But of course, it depends on which sector or which asset class you're talking about. For example, for stock market, it should be good. But for the gold prices, it may not be so. At this moment, it has been reaching the resistance at 1,300 somehow, and get retreated back to 1280, something like that. So at this moment, I think some kind of consolidation around the level should be in place. But of course, if the Fed is going to put a hold on the interest rate hike in 2019, I think the general comment should be rather positive for gold prices.
Okay, Mark, just one quick question before we wrap this up. I think when I was reading the Bloomberg website, a lot of opinion came in about how there will be more such liquidity measures taken by the PBOC in order to offset the impact of the MLF loans during the coming quarters as well. Are we to presume that if that is indeed your view as well, then while there might be consolidation right now, the downtrend in commodity prices might just have gotten broken?
Well, for the Chinese authorities, I think it is really a difficult moment for them to have a large movement in their policies, both fiscal policy and monetary policies, because stability is of paramount importance at this moment. And I don't think that they can have too much or too drastic measures at this moment. Rather, they should build up some kind of a positive impact by the expectations management, which I think they are now exactly what they are now doing. But of course, I don't think that they can inject too much liquidity without the impact on asset prices. They have been very concerned and very careful about this. I think they will keep on it.
Okay. Mark To, we'll leave it at that. Thanks so much for taking the time out and joining us and giving us that perspective. Really appreciate your time.
Thank you.
Well, Mark To doesn't believe that there will be a big up move, maybe consolidation of the current prices, but if the ADRs of some of the stocks are to be believed, there'll be an uptick in the session today. The question mark only is, will that last? Let's see. Vedanta was hitting 52-week lows on Thursday or Wednesday. Let's see if there's some much needed upside to these stocks. 2.5% up in Friday's session. Let's see if there's more upside here. Okay, the next piece on First Word. 2018 has been described as a year where volatility returned to India. It holds true after an exceptionally calm 2017, but not when one looks at the overall trend in Indian equities. And Kannan is here to explain to us why. Kannan, now tell us, why are you saying that 2018 was not a year of extreme volatility?
Yeah. So if you believe 2018 was a volatile year, think again. If statistics are to be believed, 2018 was as normal as 2017 or 16.
Okay.
Right? So we did a research on Nifty return distribution for the last 9 years, since 2010, and we observed the magnitude of the fall on a weekly and a monthly basis greater than 3%.
Okay.
So what is interesting is the findings of our study reveals there are 33 times when Nifty index fell more than 3% on a weekly basis since 2010. So statistically speaking, this is like once in a month event, right? So if I may pull out the chart, I can actually show you the return distribution, right? So this is what we have observed for the last 10 years, and we have taken anything above a fall of 3% and above, right? So if I pull out the next chart, that actually shows that the return distribution on a yearly basis,
right?
So 2017 we saw none on a weekly basis, whereas the statistics say there is a once in a month expectation. So we did this access.
A move of more than 3% happens once in a month.
Yeah.
And you are saying in 2017 we didn't have too many instances of that.
So the weekly fall of anything greater than 3%.
Right.
As a once in a month expectation. But 2007 we saw 1, and 2017 we saw 1. Right. So we did the same analysis on a monthly time frame, where there are only 22 months in the last 9 years where the Nifty return fell more than 3%.
Okay.
Right. And 2007 saw none.
2017 saw none.
And 2018 we saw 4.
Okay.
Right. So this is very interesting. So people thought that 2018 was a volatile year because we have some spikes in February crash, and we have some spikes in the last quarter, but it is none. But a mere volatility level doesn't say anything, right? So the VIX is currently trading at 15-16%. What does that indicate, right? So what we did was to dissect this. So we did a box plot from the descriptive statistic to say that where is the volatility standing today? How can portfolio managers can meaningfully interpret this, right? So what is this box plot? So box plot actually classifies volatility into quartile, so 25% bucket, right? And if you see this, the middle line or the median values, right?
Okay.
And the space between these boxes or the dispersion that actually shows the degree of the dispersion and the skewness on the kurtosis, right? For 2014, which is the election year, we saw outliers of magnitude of 30-35% spike.
Okay,
right?
so these dots are the outliers. A lot of other spikes.
A lot of other spikes,
okay.
right? In 2015, we saw with the Chinese crash, and again in 17 we saw one. But 2018, we saw none of those outliers, right? Despite market being volatile in the last quarter.
Okay.
Right? And the median value, which is the middle line,
which is this one.
This one, yes. So it is 14% when compared to 12% on 2017. So in all major basis, like 2018 was a non-volatile year, if statistics are to be believed.
Okay.
Right? But as we move towards 2019, will the volatility stay same? May not be, because 2014 has a clue, which is an election year. We saw some kind of uncertainty picking up, and we saw some outliers. So 2019 could well turn out to be an election, volatile year, but 2018 definitely is not a volatile year, for Indian markets.
Okay, so it may have looked volatile, and certainly on certain counts it was.
Yes.
But if we look at past statistics over the years, 2018 was volatile maybe compared to 2017, but otherwise wasn't.
Wasn't, yes.
Okay, and there might be a return to volatility in 2019.
That's true. So portfolio managers who still haven't edged the tail risk, right, should continue to do so, because the volatility still remains low.
Okay, interesting. Kannan, thanks so much for bringing this piece to us. So, well, maybe a return to volatility in the next year, which is 2019. Okay. Well, if the recent volatility was bad enough to hurt equity markets significantly, but did it bring some of the sectoral leaders off from their thrones? At least from the stock market perspective, leaders in some of the consumer-related sectors have taken a beating. Darshan Mehta is standing by with, 10 industry leaders trading at 52-week lows. Darshan, very interesting. You don't normally see this phenomenon.
Yeah, not all of them are at 52-week lows, but quite a few of them have corrected significantly. And basically, these are the sector leader or the brands which have fallen. So you're used to some of the smaller companies falling, but you're not used to an Aisha correcting 35-36%. You're not used to seeing Page, which was at 36,000 now at close to 20,000. So these are 10 stocks. We've picked up 10 stocks. We'll quickly run through them. But these are the sector leaders and marquee names which have fallen. So the first stock that we want to talk about is Page Industries. Very surprising. It's fallen almost, Page Industries has fallen almost 36% from the recent high. So there is traction on the negative side. Couple of reasons why Page Industries has fallen significantly. First of all, valuation still high. Even after the correction, it trades over 50 times. And the revenue growth was slowing down. So if you see the second quarter, the revenue growth was just 10%. So that's hurting Page Industries. Analysts, however, remain bullish on Page Industries. If you looking at Page Industries at this point of time, still there's a potential upside of 18% that will come in on Page Industries. So that's the trend that you're seeing. The second stock we want to talk about is Eicher Motors. Now, Eicher Motors has corrected almost 32% from the recent highs and pretty much at a 52-week low. If you're looking at what the reasons for Eicher Motors' performance was the fact that the auto sales number were weak. When people thought that November was a one-off because of the Chennai issue, again, December was the worst, a negative 13% drop. And competition and price hike concerns because of ABS as well as insurance, that is something that is hurting them. Java came out with a spectacular set of bookings, so that is something that will aid Eicher Motors. What are analysts saying on Eicher Motors? Analysts still believe there's a potential of 27%, but the number of sell recommendations have also been there on Eicher Motors. Third one is Symphony. Symphony has fallen almost 50% from the 52-week high. It's recovered from recent, but nevertheless, Symphony, weak financials, high competition, high valuations, all these factors are impacting Symphony. If you're looking at the analyst recommendation, not too much of a brokerage coverage. There is there is some bit of coverage, but there is still, even from these levels, the return potential is still negative on Symphony. The next stock is Maruti. Maruti's fallen almost 27% from the recent highs. Clearly, monthly sales were extremely weak due to the slowdown, high valuation versus competition. That is something that's impacting Maruti. But even if you're looking at it, still analysts have targets in excess of 10,000 for Maruti. So that remains, and the potential upside is 13%. Blue Dart, again, Blue Dart is down significantly from the recent highs, down 30%. High valuations and weak financials and weak margins are something that has impacted Blue Dart. Again, if looking at it, not too much of an analyst coverage, but still a negative return expected. VIP industry, VIP industry is down 20% from the recent highs. Weak financials and increasing crude have been some of the key reasons why VIP is down in trade. The other few companies that we want to run by, Coal India, again, Coal India is down almost 25% from the recent highs. Weak production and sales data was something that impacted. Declining inventory, declining e-auction volumes, high capex, all these factors impacting Coal India, and PSUs as a basket has not done well. Venki is the largest poultry company in the country. That has actually fallen 50% from the recent high, so there is enough traction. Numbers were weak, rising raw material cost is impacting, and so is the case with Avanti Feeds, which is the largest feed company. That is down almost 60% from the recent high. Again, rising raw material prices, falling shrimp feed prices, all of them impacting. And finally, from the real estate pick, the largest company is DLF, at least till now. That has fallen significantly. So DLF has fallen significantly from the recent high. Slowdown in the sector, and the NBFC cash crunch is something that is impacting the real estate sector, and that has also affected DLF.
Well, a bunch of names, some expected, some not so. Not too many people anticipated some of the names to come off so starkly in calendar year 18. Darshan, thanks for putting that into perspective. And maybe that hurt some of the portfolio managers as well, because 2018 by and large was a tough year for some of the portfolio managers who don't seem to have managed to recover from the rout in the mid-cap space. The liquidity scare in the NBFC space only added to the woes. Sajid Mangat has collated all the data released by the portfolio managers to draw up a list of the best and the worst performers of 2018. Sajid, pretty good or not quite?
It's a mixed bag, but for some of the large portfolio managers, it's been a bad year. So let's set up the entire thing before we go into the return. The year, if you look at the returns, as such, Nifty had a 3.2% return, the Sensex 5.9%. Mid-cap at the end of it was negative 15.4%, and that was primarily because in the first half of the year, we saw a big mid-cap carnage happening. And many of the portfolio managers were heavily stocked up on mid-caps, and that hit them very hard in the first half of the year. But we saw that mid-caps returning back in the fourth quarter, because in the fourth quarter we saw the mid-cap, the NSE mid-cap 100 giving a return of nearly 4.2%, when Sensex and Nifty both gave a marginal negative return in that quarter. So there was some bounce back for mid-cap, but it was not enough for the fund managers to come out with a positive return if you look at it. On a quarter 4 basis, if you look at the average return for the fund managers, it was 2.5%, which was the highest in that quarter in the year. The quarterly return which was there. On a H2 basis, or the second half of the year, it was negative nearly 2% for the portfolio managers. Now let's come to the top fund managers by assets. Now you have Quantum Advisors, Motilal, Inam, ASK Investment Bank, investment managers, Alchemy Capital. These are some of the ones which have more than 5,000, with Quantum, Motilal and Inam having nearly over 14,000 crores in asset under management. A lot of that chunk is basically corporate FI money, which they're managing the portfolio management business. So in the top 5 based on assets, only Quantum was the one which had a positive return of 1.2%, and the rest all had a negative return. This positive return also came in the last quarter of the thing, so it's not a uniform performance which we saw there. But the surprise was the best performers. The best performers were portfolio managers who had assets under 500 crores. You have some of the good new names like Club Millionaire, which came out with an annual return of 21.2%. DMZ partners.
Ambit 2 is a new entry.
Ambit 2 is
it's a 1-year-old portfolio.
It's a 1 year because they sold off the entire thing to Avendus, and so it is also a new entry which has come in. Ambit, DMZ, Basant Maheshwari, Anand Rathi Advisors. These were some of the fund managers who made positive return and almost double-digit returns for the full year. The best part is that you need to take out 2 of them. One is the Club Millionaire, and the second is Basant Maheshwari, which had a Q4 return of over 10% each. So they were hit very badly because in the second half or middle of the year, they were hit because of the kind of NBFC thing. But they came back strongly in the fourth quarter, posting a 10% plus return in the fourth quarter, which is the October to December. Among the worst performance, you have Equity Intelligence, which is Purinju's fund. Now that was the worst hit with 44% negative return which happened. Then you have Kotak AMC, Reliance Wealth, Karma Capital, Envision. These are the ones who had more negative returns of more than 20%. So many of it was a bad year for portfolio managers who were betting on mid caps to get returns, because mid cap carnage in the first half of the year did not do well for them, and they were not able to come back from that hit. It's going into 2019, they still have a negative return to follow because investors have put in money. So in total, if you look at while there will be of the top 50, 2,000 to 3,000 crores of assets which have been declined. In the top 10, we saw over 5,000 crores of assets going down for some of the fund managers in the top 10 based on asset under management. So it's not so pretty picture for some of the top fund managers there, and the outperformance are the smaller ones who are now gaining traction. Of course, they have small amount of asset to manage as well.
The size matters too.
Size matters, but the point is, it's not about size. You're investing and you're getting the return. So it's about your stock selection. So someone is like a Basan Maheshwari who went in with blue chip stocks, managed to come back strongly, but others who were betting on mid caps, small caps may not have.
Yeah, the question mark only is, will 2019 give some tailwind to those portfolios which have underperformed until now and then recover? Thanks so much, Sajid, for bringing this to us. And Sajid would say in all of his stories as well, a lot of investment products are long-term products, so please take that into account before you try and assess. This is more a report card of what some of these portfolio managers have done. In fact, I urge you guys to go onto the website and search by some of the stories that Sajid has done in the past as well for quarterly performances of some of these portfolio managers as well, and that gives you some very interesting data. So Sajid, thanks for bringing this into perspective. The last piece on First Word today: Jet Airways lenders have given promoter Neeraj Goyal till the end of the month to submit a revival plan. This after the country's second largest private airline defaulted on loan repayments on the 31st of December. Vishwanath Nair has spoken to a couple of people involved in the negotiations. Vishi, what are your sources telling you?
So according to the sources, these negotiations pretty much gave the promoter time till the 21st of January. They said that you have to submit a resolution plan, a revival plan, and two important parts need to be there in this plan, which is equity infusion, fresh equity infusion, and a sale of assets so that you can monetize it and thereby repay some of these lenders. Remember, this company has not repaid its vendors and employees for the last couple of months, and therefore the company had requested lenders to give them about 1,500 crore worth of interim financing so that they can repay vendors at least. But that request is still pending at this point in time. Bankers have not taken a decision on whether they want to extend this funding to the company. They're going to take that call later this week when there is going to be a meeting, as we understand it. The idea being 21st of January, why that is important is because remember that the RBI's asset classification norms have a 30-day mark, right? So if you're in default for 30 continuous days, then you enter something known as an SMA-1 category. Once you enter SMA-1, then it becomes the bank's responsibility to ensure that there is a resolution plan, and therefore banks will swing into action and take their own calls. So they're giving this time to Neeraj Goyal till 21st of January. The remaining 8-9 days will go into negotiations and discussions. They're giving them time till that point in time because they want the promoter to come up with a plan first. If the promoter fails, that is when the bankers will swing into action and take their own calls in this matter. But suffice it to say, the lenders have already told the promoters that maybe you could get Etihad to buy slightly higher stake. They own about 24% in the company right now. You could get them to buy more stake. But if they're not able to, then probably arrange for equity from outside. So essentially, that's where it is right now.
Not something that he wants ideally, but might just have to do it.
Looks like there might be some kind of dilution for the promoter stake. So that's something that probably Neeraj Goyal does not want right now.
Yeah, but as we said, might have to do it. Well, till 31st of December, I think the month end, 31st of January, excuse me, is the time that he has. Vishi, thanks for putting this into perspective. I'm sure Vishwanath Nair will keep us up to speed with all that happens during the course of the month as well on Jet Airways. But that's all that we have on First Word for the day today. Lots more lined up for you on Indian Open. Do Jerome Powell's assurances ease liquidity concerns for global markets and EMs in particular? Johan, Jooste of Bank of Singapore joins in to speak about that. Naveen Jindal shrugs off raw material price concerns in the steel sector, but not in the power business. We get you that conversation a bit later on, and then talk to the country's largest animal healthcare company to understand how the business is placed for 2019. Manish Gupta, SeQuent Scientific, will be joining us. But after this break, a full tilt towards the day's trade.
What started out as a quest for good coffee has turned into a single estate specialty roast coffee connoisseur's paradise.
It was purely, this is something that we want. We're looking for good quality coffee.
Theirs is a story of starting something amazing and new and refreshing.
It wasn't just Nat and me who were taking this journey to change the coffee landscape in India, but it was actually going to start from the farms.
The face of coffee in India has seen a sea change in the last few years. And it's owed now in a small way to Matt and Namrata, the founders of Blue Tokai Coffee Roasters. Watch their exceptional story only on Bloomberg Quint.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that will sustain.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We are getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Watching IndianOpen right here on Bloomberg Quint. It's a day of green across Asia, so anticipating a slightly more stronger start in line with what the SGX Nifty is also indicating. That's the Asian market wrap for you. You've got about 2.8% gain on the Nikkei after that 3% slump on Friday's session. Shanghai gains another percent and Hang Seng is up 1.25%. For the SGX Nifty, 1% higher, so it's a strong start, a strong footing. 10,887 coming out from last week's 1% dip on the benchmark indices. Let's see what happens this week as we step into trade, though it was a key outperformance of the broader markets. The mid caps and small caps did really well. But leaving that aside, it's also important to keep an eye out on the futures and options skews and how does trade look like as we step into this week. Agam Vakil is joining in right now. Agam, good morning.
Good morning, Devina. Well, what we're seeing is subdued cues coming in, even though we did see some longs coming up when it comes to trade last Friday on the Nifty futures, where we did see an increase in open interest of as much as 1.7%. The Bank Nifty futures also seeing an increase in open interest by as much as 2%. And the WIX, of course, came off by nearly 4%, coming down to levels of around 16. Now, in terms of your open interest change and distribution, perhaps first we talk about distribution. We have maximum open interest in the 10,500 put on the lower end and 11,000 on the higher end. That's a 500-point range that we are working with, within which you can expect the Nifty to move within the near term. And of course, at least as far as Friday is concerned, the most active options were well far away from the current level. That is a little more writing in the 10,400 put and the 11,300 call. Coming down to your stocks, Adani Power and Jet Airways remain in ban, and we have the put call ratio, which is unchanged for the Nifty, and the Nifty Bank put call ratio edging up higher to around 1.12. In terms of stocks, watching out for Mindtree, some weakness coming in. Bharti, in fact, on the other hand, seeing a lot of longs, and it's the same for Apollo Hospitals. And in unwinding, what we're actually seeing is Siemens and something like an ONGC, which is seeing short covering coming through. On the whole, mixed cues, but broader markets doing much better in comparison to your benchmarks, and we will keep an eye on cues, the similar cues going in today's day of trade as well.
All right, Agam, thanks very much for that. So that's the futures and options wrap up. Like we've been discussing, the resistance and the upside shifting lower to those 11,000 levels from the earlier 11,200. Samir Kalra, founder at Target Investing, joins us on the show right now. Samir, good morning to you.
Good morning.
It's going to be interesting. A lot of stocks which could be active on the back of specific news to it. Firstly, you've got Titan, and talking about the positive jewelry business, the growth that they have seen, 22% for the full year. What's the idea now? Do you think that this is a stock worth looking at?
So I think if you see the valuations of the jewelry business, they've reached almost a previous historic peak. And if you see the watch business, that is contributing now towards the incremental EBITDA. So that is helping push the total EBITDA. So if you see past couple of quarters, what has happened, jewelry business has flattened out on the profitability, and the watch business is giving that up leg from the online business. So I think over there, the online watch business is much more contributing to the whole incremental profitability now. And that's where the whole trigger is. And we discount the jewelry business as of now. Because what happens over there, the capex is really high. And the seasonality hits the numbers at a certain point. So I think that cycle is about to get over on that kind of a growth. Because the capex which you've done is quite high now past couple of years, and that to maintain that SSG number in that certain sense becomes much more difficult. So I think over there there'll be a certain slowdown in the jewelry on the profitability side, and there'll be much more pickup on the watch side.
But keeping in line with even the gold prices now, which are at these elevated levels over the last few days, being considered as a safer haven investment, so much of the money going in there, do you think that will support?
So I think if you see, for them the raw material cost increases. For them the pure gold is much more the raw material than the end customer, investment.
But they get a positive inventory.
Yeah, they do get it, but the only point is the incremental inventory which you're buying for the running, that goes on the higher prices. So then the margin somewhere or the other starts to reduce, or it's more difficult to pass on the prices. So over there it becomes a net-to-net kind of a marginal impact on the positive side.
Interesting. Let's see. Titan might react positively to that, and to this news though. Samir, not completely convinced with an up move possibility out there. That's one stock in news. I think there are a bunch of others that we'll get in our research team to talk about as well. So Nikki should be joining us any moment to talk about all the stocks in news. And then, of course, we'll also get in some brokerage calls going as well. Just while we are at it, before we get in, Nikki, Samir, since we're talking about Titan branded business, we just did a small piece on how some of the branded businesses have come off. I want to take two names out here, Page Industries and Eicher Motors. Heavily priced stocks have come off quite rapidly from their highs. Are they giving opportunities to make a fresh investment in?
So I think Page may not be that kind of a story, because what happens when you're sustainably growing in that sense, and there is a certain taper off in your growth, and especially when you are able to expand automatically. See, Eicher is a more heavy investment and capacity issues led. Page doesn't face that kind of a issue. And then over there are certain indications that the whole market is kind of saturating in a medium term. Let's not say on the longer term or a shorter term. In the medium term, there is a kind of saturation which will hit your valuations. And being a illiquid stocks, both ways, the impacts will be much more higher than what they were. And especially on the average of trading average of 55-60 times. Now if you're going 70-75, there is meant to be a correction. So I think out of both, I think Eicher is giving a better opportunity, because they're facing a capacity issue. And there is a whole slowdown in the auto industry in the short and medium, according to us.
So then why is it giving an opportunity?
So I'm not saying the opportunity is to buy right now. Maybe another 6 months or 3 months when the whole system gets into the base. That's the opportunity, not right now. There is a further downside. According to us, we have reduced our auto stocks weights by 80%.
80%?
Yeah, because if you see the registrations, they have fell around 12% in each segment YOY. So that gives a very big build-up on the inventory level. That's why the wholesale numbers are coming more dismal than what people are expecting.
That's interesting, because even Samir Arora said that, he's pretty much out of auto except for a Maruti that he has.
Practically a short trade as well.
Yeah, and yeah, very small position on the short side, but yeah, out of auto completely.
Yeah, very interesting. The only point was that the FADA gentleman who came in the other day, I heard that conversation on air, and he mentioned that the last 15 days of December were not that bad, and he was confident that January will actually turn out to be a decent month. Well, let's wait and watch. If new registrations, as Samir says, are the problem, then maybe there is a problem.
There has been the problem of the huge inventory lying with distributors as
for a
well.
while now.
So they need to get rid of that old inventory before they start placing new orders with these manufacturers.
Yeah, let's wait and watch how it shapes up. The numbers will tell us. The month of January will be extremely crucial. Okay, let's get in some other stocks in news. In fact, the key stocks in news as well. We're speaking about Titan, Agam Johnson to give us that update, and then Nikki Johnson with all the other stocks in news as well. Agam, actually, I'll start off with you since we are talking about Titan first. Can we just lay out the numbers, and if you have a sense of any brokerages having come out with the notes?
Right. So, well, as far as the third quarter update is concerned, Titan is very, very positive, very constructive, especially in the jewelry business. And based on that, I think the key takeaway is that they're pegging 22% growth for their jewelry business, which means, according to our calculations, about a 28% growth for the second half of the financial year going ahead. This also means that they're going to have to keep up with a good run rate. But do remember, the third quarter is a one which is seasonally very strong for them, considering the wedding season. And as we all spoken about to the management, and something which has been comprehensively covered is that the management is looking to focus into the wedding jewelry segment specifically. And moving on, we also have updates when it comes to its watches segment, where the growth remains healthy, largely on modern trade channels and e-commerce. And also they've added that their smartwatches collection is something that's driving growth. Now, as far as brokerages are concerned, I do have a note from Macquarie, and according to their estimates, they are very much on. Titan is very much on track to achieve that 30% growth for the second half this financial year. And once again, they are also of the opinion that Titan is going to be one of the outperformers, which is why they are positive and remain constructive as far as Titan company goes.
All right. We've got Nikki now. She's joining us with the stocks in news. Nikki, what's on your plate?
Well, a couple of bank and finance companies that we're talking about. First, I'm going to be addressing Bandhan Bank and HDFC Group Finance. Both of these companies' board would be meeting in today, and Bandhan Bank is set to acquire Group Finance via share swap deal. Currently, HDFC holds around 57% stake in Group Finance, and with this deal, Group shareholders are expected to receive 3 shares of Bandhan Bank for every 5 shares held in the company, and HDFC overall may end up with over 10% stake in the combined entity. Also, we're looking at ICICI Bank, which along with venture funds have quit the race for IL&FS due to the conflict of interest. Now, do bear in mind the fact that Jhunjhunwala also is one among the contenders who's looking to acquire in the security business of IL&FS. Apart from that, we're looking at IDBI Bank, where S&P has revised the credit rating to a BB stable from a BB negative, watch negative, because the bank and the rating agency now expects the bank to meet the regulatory capital requirement post capital infusion from LIC. Also, we're looking at SOBA, which is given a quarterly update where it's spoken about the share value, the sales value coming down by as much as 2% quarterly, and also, however, the realization during the same period has inched up as much as 1%. In terms of the new development, it's going to be the developer is going to be launching in one more affordable housing project in Gift City in the next span of 2 to 3 quarters. We're looking at Bharat Forge, RK Forging, and GNA Axles. North America Class 8 truck orders have been the lowest that we've seen since August 2019. And also, last on the list that we're going to be looking at would be ITC, because the ministerial panel has suggested a 1% calamity cess for Kerala on all or selected items for the span of next 2 years, but then there have been no specific tax which has been levied on cigarette specific. This, according to Macquarie, is a great positive for ITC because Kerala contributes to around 10 to 11% of volume for ITC.
All right, Nikki, thanks very much for that. So keep in mind all of those stocks as we open up for trade this Monday morning. Some more brokerage calls to keep an eye out for. Samit Sarkar joins in with that. Samit.
Well, a couple of them. The first one is on Tube Investments, where Access Capital has initiated coverage with a buy rating and a target price of 470. Now, according to the brokerage, Tube Investments is a multi-bagger in making, and it expects the stock to double in the next 3 years. Now, the brokerage is expecting the company's profit before tax margin to reach 10% with a possible upside surprises on the back of growth driven on operating leverage benefits, fixed cost reduction, efficiency gains by reducing the internal rejection rates, higher realization from scrap sales, reduction in logistics cost, and because of a lower finance cost due to no debt of the company. Lastly, the brokerage sees improving export revenue, capturing product opportunities in related products and inorganic opportunities as key growth drivers for the company going forward. The second note we have is on PVR, where UBS has maintained its buy rating on the stock but has hiked the target price on PVR to 1,905 from 1,516. According to the brokerage, screen additions will fuel higher growth for PVR going forward. Now, the brokerage is expecting PVR screen count to reach a total of around 950 by financial year 2021 from current 835. Now, along with this, a GST rate cut to 18% will give PVR a level playing field with single screen operators and will help PVR grab market share from them, says the brokerage. Now, the brokerage believes that PVR will be valued richly due to high earnings expectation and content risk diversification as it penetrates deeper into the southern India market. Lastly, a fundraiser through equity and a pending verdict on outside foods and beverages are the key overhang on the stock, says the brokerage.
Okay, Samit, thanks very much for that. Those are some brokerage calls early morning. Samir, firstly, Jet Airways and what's happening there. They've got a deadline of about 21st of January. They have to look at monetizing assets or look at some amount of equity infusion. The stock has anyways, been out of favor for a really long time since the problem started. What happens now? And then what happens to your Yes Bank investment, which you've been making since some time now? I mean, do you start looking, because it's not done anything so far?
So I think let's take Jet first. If you see over there, a deadline will really not help the cause. Because the only point is the seller is ready to sell, but there's no buyer upfront who's showing that kind of an interest or that kind of aggression right now. Because the only point is right now all the actual investors or the strategic players are already there on the ground, and they're not interested in buying a debt-ridden firm. Over there, if you see, the cash flows are the problem. The kind of rationalization they've done to help next 3 months is good enough. But the only point is the lenders will only give a reprieve to them if they show a medium-term plan, which I think even if Etihad being Etihad and the cash flows they have externally, even if they are not supporting Jet at this point of time, then there is something really big trouble happening over there, because the books are already inflated in the terms of the debt. And the repayments are coming out in FY 2021 on a higher side for the principal of the debt. So I think every investor or interested buyer is keeping away to see what lenders do, because if it goes further down in terms of valuations, then there might be a scope for an interested buyer, not at this point of when the unknowns are still unknowns and there is a further downside to the whole thing. On the Yes Bank, I think our investments are not supposed to pay off the moment we start buying. We have a horizon of at least 3 to 4 years. Okay. So over there, the investment horizon is longer. And see, for us, any kind of disappointment right now in the shorter term will only help us add to the weight. Because as an organization, we don't see any issues with it. The promoter issue or the succession issue, I think next 1 month or 2 months will be sorted out in the medium term.
Okay. We'll wait for that. Stay on, Samir. So much more to talk about. Lots of updates and lots of stocks to discuss. But getting our technical experts on board now to talk about charts. Also get you Bloomberg Edge in just a moment from now. But Ruchit Jain, technical analyst at Angel Broking, with his thoughts on the charts, as is Brijesh Bhatia, head of research at Dealmoney Securities. Gentlemen, both of you, good morning. Thanks for joining in. Quick thoughts out here. Ruchit, will start off 1% higher. Is there a trade that exists for a trader at those levels?
It's very good morning, Neeraj. Neeraj, if I just look at the recent past since the first week of December, then our markets have traded in a range with higher volatility. 10,600 to 11,000 has been the range in which this entire last 1.5 months activity has panned out. Now, if I look at Friday's trading session, we have managed to give a pullback move exactly from the lower end of the range, which was around 10,600, 10,620. And not only on the Nifty index front, but also on the Bank Nifty index front, that support of 26,900 has been held on Friday, and we had seen a decent pullback move. So I think till these supports are intact, one should trade with a positive bias. Even if we continue to trade within this range of 10,600 to 11,000, we could see the index heading higher towards this 11,000, 10,950 odd levels. So even if we see a gap up opening of about 80, 90 points, I would advise creating fresh long positions. One can initiate fresh longs to 10,900 call option. The closing was around 115. Even if you get around 120, 122 kind of levels, one can go long, keeping stop loss below 75 rupees, expecting target around 180 to 190. Traders should specifically keep these two levels in mind. On the Nifty front, 10,600, and on Bank Nifty, 26,900. Till these two supports are intact, trade with a positive bias. Only when this support gets breached, one should change the view.
Brijesh Singh, what would you do? Sorry, Brijesh Bhatia.
Yeah, morning. I would slightly wait for Nifty to buy around 10,000, maybe around 830, 850 sort of levels, and slightly avoid going long on at the opening, even if it's opening 80, 90 points higher. I would like to go long on Bank Nifty rather than Nifty. If you look at the Bank Nifty, was slightly strongly outperforming, as Ruchit has mentioned, 26,900 is strongly ahead, and we have seen again a positive momentum towards 27,200 in last session. So I think 27,600, 27,630 could be levels on the upside one can look at. So I think one should look for 27,500 call in case markets slightly open higher, or in case you get around 27,250, 27,300 spot levels. So you can look for going long on future directly for the target of around 27,600 on the spot. So maybe around 27,700 on the futures level.
Okay. Stay on. We'll just get in your stock-specific recommendations as well, but it's time for our special segment, Bloomberg Edge, wherein Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a stock. Yash, what's the stock on our radar today?
Morning, Neeraj. So we are tracking Aurobindo Pharma on the charts today, and the formation of a bullish engulfing pattern suggests further upside to the rally. Let's first try and understand what the indicator is. It is basically the formation of a bullish candle right after a bearish candle, wherein the body of the second candle completely engulfs the one ahead of it. The longer is the body of the second candle, the greater are the odds of a rally. No additional confirmation needed. Now let's take a look back at the chart, and we saw on the back of heavy volumes, the stock went up on Friday. It closed the day higher by about 2.5%, and with that, it has completely engulfed the red candle in front of it, suggesting that the move on the upside could start from these current levels.
Okay, and how well has this worked for Aurobindo Pharma in the past, Yash?
So Neeraj, on an average, every time that the indicator has turned positive, one could watch out for returns of close to 4.5% over the next 1 month, or actually 5% over the next 1 month.
Oh, well, let's wait and watch if that happens this time around or no. But thanks for putting that into perspective. Yash, do watch out for Aurobindo Pharma. That's the Bloomberg Edge for the day today. Let's talk about specific stocks. Ruchit may not have a pharma stock up his radar, but he has got a couple of other stocks too. By the way, just a brief programming insight. For a deeper insight into Indian equities, do visit bloombergquint.com, wherein S. Kannan decodes Bloomberg charts on a specific stock every day to identify the technical triggers that have emerged in them. On today's Bloomberg Edge, on the website, we feature Bajaj Finance and what its open interest and volume charts indicate. That is a BQ Blue exclusive. Okay, so those are a couple of Bloomberg proprietary indicators. Now let's go to our experts and try and figure out what trades they are recommending. Ruchit, Muthoot Finance as well as Delta Corp. Why do you like them?
Yeah, so if we look at the entire NBFC space, we have seen a lot of volatility in this space in last 4-5 months. But in spite of all this volatility or the corrections in many of the names, Muthoot Finance has been an outperformer in this sector. Also, in last 1.5 months, the up moves have been supported by very good volumes. So generally, whenever these two criteria meet, the one is the up move supported by good volumes, and second is the outperformance within the sector. I think those stocks usually tend to give higher returns than its competitors. I think Muthoot Finance, the trend is also positive. Hence, I am recommending to go long at current levels, keeping stop loss below 474. In short term, we expect the target of around 555, 557 on the higher side. And Delta Corp has been recommended only from a trading perspective, very short-term trading perspective. Last few trading sessions, the stock price is consolidated above its 89 EMA support, and on Friday, the prices gave a breakout from that range with very good volumes. So the breakout with good volumes has been seen in Friday's session. So this should lead to an up move in Delta Corp in near term. Buy with stock below 238.5 for target around 294.
All right. Those are some of the stock ideas from Ruchit. Brijesh, you've got a whole host of stocks as well. Manappuram Finance, you've got a buy call on M&M as well as an SBI.
Yeah. So let's start with Manappuram. So if you look at this space, already financing has been good, showing good momentum, and this stock was slightly resisting between 89 and 92 for quite some time. And we have seen the stock moving above, now it's 200 days average. So just slightly looking at the historic in last 2-3 years, when stock has given a positive crossover above its 200 days average on the first time, the stock has a tendency to run around 8 to 10% on the upside. So at around 95 rupees, I think if you look at this, just around 10%, it comes to around 103, 104 sort of levels. So I'm betting on looking at the historic momentum and looking at the volume price breakout. I think Manappuram is a good bet in this finance space at around 95. One can look the target of around 102 on the upside, keeping the stop loss of 92, which was previous resistance zone. Second is M&M. So if you look at the M&M after post numbers, the stock has seen a strong selling pressure coming on in the space. So at the momentum, purely playing the momentum side, the chart is slightly into oversold territory, and if I look at the pattern, there is a bullish bet which is a harmonic pattern developing at around 710 sort of level. So we have seen strong reversal coming on from around 712 on M&M. So purely from a momentum play, one can keep a stop loss of around 704, 705, which is around 20 points, and look for target of around 765, which is around 40 points on the upside. So purely playing a momentum play and a reversal bet, looking at the charts are being slightly in the oversold territory and patterns being forming. Third is SBI. So if you look at the SBI, PSUs are giving good momentum on the upside. We have already seen Union Bank and Bank India moving out. SBI also moving out above is the resistance on around 290, 292. And weekly close above these levels for quite some time, showing a strength in this space. So being a big elephant, it's the general tendency that stocks generally move these slower legs. So at around 297, I'm expecting around 310, 312 on the upside on the stock, and one can keep a stop loss of around 290 on SBI.
All right. 2.5 minutes left to go for market pre-open. And Samir, I just want your quick comment if you've been through the news of Bandhan Bank and Group Finance, and how does this entire deal shape up for you?
So I think it's more beneficial to Bandhan because they get out of most of the issues, and their main issue was the promoter stake.
But that still comes out to 60. It's still 21%.
But see, it's way lower than, in a one-shot kind of a scenario. So I think over there, even if you get new investors or PE investors, you are able to dilute much further. If you see Bandhan Bank, they are more beneficial if SGFC gets only 10% of the combined at almost a 60-40% kind of a advance ratio on the merged entity. I think over there SGFC somewhere wants an exit out of the combined entity, and Bandhan, if takes over the whole book, he's able to do it much more cleaner way, in the sense that their cost of borrowing really reduces, and the group finance book really emerges the main winner of the whole system. Because if you see, they are around 9.5 lakhs per disbursement kind of average loan, and that really helps the micro book of Bandhan to come to a retail level. So that's where the whole benefit of Bandhan Bank goes from the advance and the deposit side. So I think Bandhan Bank is much more positive out of this whole merger.
So at 4.5 times, it's still a good buy?
Yeah, it's a good bank. So for us, it was good at 5 also. But the only point is, this kind of event led to more of a valuation correction rather than the business correction. So I think this kind of a merger really helps out to take them the bold decision which was pending in the system.
Okay, got that. So more beneficial for Bandhan Bank, this particular deal. 30 odd seconds left to go for market pre-open. Just a quick reference back to Asia and back to SGX. So still holding strong, holding fort there. 1% higher on the SGX Nifty. Asia as a pack looking strong though. Shanghai giving up some, and so is Hang Seng, which was up about 1.25, now is up just about 0.75%. But still in the green, 2.8% for Nikkei. SGX at 10,877. Not much of a material change out there. Just a few percentage points down. 98 odd points higher on SGX. So that's the market pre-open session, and early indications, well, contrary to that, Nifty seems to be flat. Slight negative bias though. Sensex is up 1%. We'll see these prices consolidate and stabilize in a few minutes. It's in the green now, so 10,774, 0.5% higher on the Nifty. Amongst the key gainers, you've got the likes of a Titan, and we spoke about how the reaction, to the jewelry business growth and the projection of 22% growth for the overall year is going to be positive, and the stock's up 3.5%. Yes Bank continues its upward move, 2.8% higher. Aisha Motors is some bottom fishing at 20,600. Tata Steel comes back, so the entire metals pack bounces back after the currents that we've seen last week, along with the auto names. So Tata Steel, Vedanta, JSW Steel, all of them amongst your top 10 gainers. Infosys is up 1.3%. India Bulls Housing, that's up 1.25%. TCS has moved up 1% now. So a change in the top gainer. Yes Bank comes right at the top right now. Cipla is up. Bajaj Auto moves up right now. 0.5% gains. Maruti Suzuki up 0.5%. Bajaj Finserv too gains another 0.5%. For the currency though, a slight amount of, in fact, we're looking to appreciate to 69.36 now from 69.73 where we closed out on Friday session.
A far cry maybe a few days back, but it's been strength that we're seeing. I would presume this is in part due to what's happened on Friday, and almost every large house that wrote on Bloomberg.com about what the dollar could do expected the dollar to weaken in calendar year 19. So I would presume this would be in part due to that. The bond yield should come up on your screen as well, and let's see what they are doing. 7.44, so that continues to hard, and I don't know, there's a reflection of what crude prices have done as well. They've bounced even further. So I don't know if it's part reflection of that, but while the rupee is strengthening, the bond markets are weakening. It's an interesting bit of a dichotomy in the last few days for these names. Okay, just 2 or 3 names that I want to spot out. The ITC should come up on your screen. Sobha should come up on your screen. A couple of names that could well have a reaction. ITC a positive one, Sobha maybe a negative one, should come up on your screen. And then 2 or 3 names, actually Bandhan and Growth Finance, if we can pull those up as well. And let's see if the market is duly reacting to what the Times of India and Mint were reporting. Bandhan up about 1%. Growth Finance should come up on your screen, about 1.5% higher. I don't quite know if Growth Finance shareholders will be terribly happy and excited about this, simply because it's an institution that has worked so well when it has not been touched. Sunil Choksi has done wonders out there, premium valuations, etc. A deal and change of guard, don't quite know what will happen here. Lastly, the ones that are out of the ASM, additional surveillance measures starting today, Merck, Nelco, Skill Infra, maybe just maybe these stocks could be in focus today and could be active today. But I think the man of the match, not Nelco is the one. Nelco should come up on your screen, and maybe that one too could be active today. But the man of the match seems to be Titan for now, Titan and Yes Bank. So let's get a chart check on both of those. Assuming that Titan starts off about 20 points higher at about 945, 950, Brijesh, would you trade it then on the long side?
Yeah, definitely I would go long till it's holding around 916 levels on momentum based. Definitely a good bet. Probably one can look at 990, 995 levels, which was the previous highs also. So in this momentum, stock can test 4-digit marks and make a new high also. So I think definitely should go for a long or Titan.
Ruchit, What about Yes Bank? That looks like starting off well today. Is there a trade here?
In the last 3 weeks, Yes Bank has traded in the range in which 193 has been the higher end of the range. So if we get a breakout above 93, then one can initiate fresh longs, but only from a short-term perspective, for target projections around 208 to 210. So I would wait for a breakout above 193 before initiating fresh longs over here.
Okay, gentlemen, stay on with us. Samir, one last question before we let you go. Where is it that you're adding positions now?
So we are adding at Oberoi Realty. If you see the whole phenomena in 2019 mid and second half, Maharashtra RERA, all the deliveries will start by according to the RERA, and there'll be a huge amount of inventory coming up for sale, or they're already on the books. Now Oberoi over there has an edge because 70-75% of all the projects are already booked, but the revenue recognition happens as per the completion. So over there, the Borivali and Worli project will come on the books. It's already 25% on the books. It'll go to 50-55 in quarter 3, quarter 4. The rental income of the Commerce 2 tower, which is the Borivali one, that has been leased now 98%. Last quarter it was around 65. So that comes in quarter 3, quarter 4. So now they have a stable income of 400 crores as a rental income, which they are planning to take it to 1,000 crores in the next 2 years. That'll be one of the best point towards Oberoi Realty over other firms. And right now they have come back to net cash of 300 crores after taking that debt for the Borivali and Worli project. So after like 6 months or 9 months, they have become net cash after being net debt. So I think over there, Oberoi Realty is the best real estate for us to pick up for 2019.
Got that. We'll leave it at that, Samir. Thanks very much for joining and appreciate it. Samir Kalra there. Bringing in one more important market voice, and Jyotivardhan, Jaipuria founder and CEO at Valentis Advisors, is joining us on the show right now. Jyoti, thanks very much for taking out the time. And how are you positioning yourself as we step into 2019? And this year again is going to be a focus on what the global cues look like, volatility from our domestic events like the election. How are you advising clients in terms of whether portfolio restructuring needs to be done, or probably stay put in some of the other bigger names?
I don't
All right.
That's unfortunately. But it'll be interesting to see.
It's a very long question for him not to hear.
No, that's okay. Just the audio glitches. But at times these happen. But yeah, I think it's an important question too, and more importantly as to whether portfolio managers whose portfolios have been hurt, do they keep the faith and stick to those ideas? Because it's not necessary that what's not done well in 2018 will not do well in 2019.
Yeah.
Or
it could be a complete reversal, actually.
Yeah. Or do they kind of switch around and start betting on large caps as well? Because the view and opinion out there is quite divided. Hiren the other day was saying that he believes that 2019 and 2020 could well be years of large caps and larger mid caps and not small caps. So
yeah, and even Sajid, when he dissected the performances of various portfolio managers. So goes to be seen whether this year turns out, because 2017 was the year
when you threw a dart and everything did well.
Exactly, and that reversed itself, a complete 360-degree turnaround.
In 2018, for sure.
Yeah.
Maybe Jyoti can hear us now. Jyoti, can you hear us?
Yeah, I can hear you now.
Okay,
yeah,
you can take your question.
No, Jyoti, so I was just asking you about how would you start 2019 in terms of advising clients, and whether or not turning around portfolios, looking at reevaluating a few stocks within them, or sticking to them in hopes of a turnaround within these companies itself?
Yeah, so see, I guess if you look at the broader market, we think over the course of this year, it will be a better year than what last year was. But it will be a volatile year, especially in the early part of the year, because I guess there are two things we have to focus on. One is the Fed and what it does. The risk to the market today is Fed tightens more than what it should, and it leads to a recessionary condition in the US. And the other for India particularly is of course going to be the election, which if you do analysis, it does not matter in the long term, but it does matter very close to the elections. Markets have generally tended to be volatile. But overall, we think it will be a better year. We'll get earnings growth coming in, and that is what is really going to drive the markets over the next few years.
As the pre-opens rates have settled down, all the Nifty 50 stocks are in the green, even though it's just about a 77-point uptick, but the mood seems to be green. I'm not saying that's how we will start off, but there's an overarching sense of green that we're seeing at the large cap end of the market. The mid caps and the NSE 500, the gainers are not too confidence inspiring. 8K Miles, DB Realty, Vakrangi, Quality are the kind of names that have moved up. But let's see if the others shine and come to the fore as well. Let's wait and watch for that. We'll continue our conversation with Jyotivardhan Jaipuria in just moments from now. But it's 5 minutes to go for the markets to kickstart trade. So let's tell our viewers all that they need to know to stay ahead in trade today. Start off with the first one. As many as 39 stocks will exit the additional surveillance measures of SEBI after this round of running. 61 stocks will still remain under the ASM framework.
Titan expects 22% growth in its jewelry segment in FY19 according to the Q3 update. This would require 28% growth in the second half of FY19.
Bandhan Bank set to acquire Growth Finance in a share swap deal according to the Mint and Times of India reports. Merger could be announced this week following board meetings of the two companies.
Soba sees significant weakness in Bengaluru and Gurgaon markets. New sales in terms of square feet declines 2.6% in Q3 on a year-on-year basis according to the quarterly update.
Bharat Forge, RK Forgings and GNA Axles would be in focus at North America Class 8 truck orders for December are at the lowest since August. December order volumes stand at 21,000 units, a drop of 43% from December last year.
And lastly, price cuts all around for automakers. CLSA has made some fresh downgrades. Eicher Motors and Bajaj Auto faced relegation, while Ashok Leyland, Tata Motors, Hero MotoCorp and TVS Motors continue to languish in the sell bracket.
Jyoti, just taking forward that point itself, high frequency indicators, mixed bag, and of course, good morning and thanks for joining in, Neeraj here. What are you doing with the autos in particular? Is it too late to sell them if you still have them in the portfolio, if you believe that there is some more downside here? Or are you a contrarian who believes that sooner rather than later the stocks will bounce back?
So from our point of view, we didn't have too many auto stocks going into this downturn because a lot of the passenger vehicles were looking expensive. The ones which we have owned have been the tractor players, which we've been playing all the way through for the last 18 months. And we continue to be positive on them, but we will probably be taking some profit in the tractor players ahead of the elections. So for us, it is like we continue playing this trade till we get closer to elections. The segment which we are looking at more seriously now and where we want to probably get in is the commercial vehicles, because we have a couple of months where the numbers will be weak, but we think going into the next year, commercial vehicle sales will be strong ahead of the BS6 norms.
Right. So that's the auto pack as a whole. Is there a change in outlook towards the financial space now? Everyone's been talking about how look at NBFCs in a new light. There's a version 1.0 and now there's a version 2.0. And what's going to happen, particularly in the banking space, with the new RBI governor coming in?
So, from our point of view, luckily we didn't own too many NBFCs before the meltdown, not because we were excited about the growth prospects, but our view was they are just too expensive. So we found them very, very expensive. I think what will happen over the next 2 quarters is that NBFCs will show very weak growth. And just remember, these are companies which everybody has bought for very high growth. They'll show weak growth because nobody will want to lend till they are able to safely reprice everything which is becoming due. So to that extent, growth will come down. Maybe these stocks will get cheaper, and if we get them at attractive valuation, we'll be buyers. Meanwhile, we've been buying the corporate banks. So that's been one of our big trades for the last 6 months. And we continue to believe corporate banks will do very well over the next 2 years. It is getting a consensus trade, so that's what worries me probably. Now going into FY20, it's probably one of the most consensus trades which we are seeing. But otherwise, that's one segment which we like a lot.
We'll have to go for market opening. We'll just come back to you, Jyoti, but let's quickly get some top calls going from our technical experts. Ruchit, why don't we start off with you?
I would recommend buying ICICI Bank from an intraday perspective. Within the private sector banks, we have seen some outperformance in last few days, and Friday's trading session indicates the resumption of the momentum. So go long from intraday perspective in ICICI Bank, keeping stop loss below 359, expecting target around 377.
All right, 377 is the intraday target there by Ruchit. Top call from you, Brijesh?
I think apart from the three call we discussed, I would go long on CanBank. So if you look at the momentum, it has given a double top breakout on pointers, bigger charts, short-term charts. So at around 283.84, one can go long for target of around 291, 292 on the upside, and one can keep a play stop loss of strict stop loss of around 279.50, slightly lower below 280, which is the support zone on intraday basis.
Okay, Brijesh as well as Ruchit, gentlemen, thank you so much for taking the time out and being with us today. Really appreciate. Have a good trading week ahead. Just 10 seconds left for the markets to kickstart trade. We'll start off in the green. It's not as strong as maybe what the Nikkei was saying or what the US markets were doing, but we didn't fall as much as the US markets did too. So expect about 0.75% in the green for our markets. Let's see what we do post that. And 276 or 300 points for the Sensex, 81 for the Nifty. The Nifty Bank about 200 points. Similar gains for all the three indices currently. The mid caps and the small caps would have a tinge of green, I'm sure. About 0.5% apiece, maybe slightly more for the mid cap space. 0.7 more in line with what the large cap indices are doing. So not a bad start. The market breadth certainly positive. Let's get the heat map and let's see what's moving and what's not. Well, except Bajaj Auto, we don't have too many stocks in the red, but well, a lot of stocks lying at the fringe right now. So let's not comment too much, but a larger tinge of green. Small gains for a bunch of them, but the winner is Titan. Post the Q3 update and strong growth seen across segments. Jewelry business, the bread and butter business, they've forecasted or they've said that the quarter has been good. So good start. Vedanta, not surprised after the Chinese reserve requirements being cut, that rate being cut. Metals by and large went up. The ADRs were active too. Vedanta up about 2.5%. Tata Steel about a couple of percentage points. So no surprise that the metal names have started off well. JSW Steel about 1.5% higher. Yes Bank amongst a couple of other names which is starting off well. And Maruti and Reliance Industries have some upsides here. So a couple of heavyweights out there doing their bit too. But Titan certainly seems to be the man of the match. In fact, if Titan is doing so well, what about some of the others? Soba and the like. So let's get the some couple of trends that I want to highlight before I hand it over to Devina for what's happening at the broader end of the spectrum. Firstly, Soba about 1% higher, so Titan 3% higher. It's a muted Q3 guidance from Soba, but the stock starting off well just about 1% higher in trade. What about the ones that are out of the ASM surveillance measures, and all three stocks start off in the green, so not a bad start for them on expected lines, but not really the 5% up move, just a muted 1%, 1.5%, 2% kind of a move for these names as well. Last but not the least, while we're talking about stocks which have gained a lot, the deal, at least TOI and Mint are reporting that there's a deal in the works. Growth Finance starts off 1.5% higher, Bandhan Bank about 3% lower. Let's wait and watch what happens if indeed the deal does get fructified. Devina, what are you spotting?
Well, we start off first with the gainers on the mid-cap space. So you've got our Deepak Fertilizers, which is up 1.9%. The likes of an OMDC up 2%. That's at 947. JM Financials does well this morning, 1.9% higher. You've got IFCI, a smaller name, 15 odd rupees is where it's trading at. Intellect Design has moved up in today's session. 221 is where the stock's trading at. You've got the likes of an Alan FS Transport, a small name, but 1% higher. AstraZeneca Pharma is doing well. Radico Khaitan is up 1.6%. Should see how Responsive Industries is doing. They've launched luxury flooring tiles, which is the first, the company's first foray in the B2C segment. It was up about 4% Friday session. Today's session just about 0.5% or so. Dr. Lal Path is the other one which is gaining ground. President Johnson, 92 on the counter. This is what it looks like. Sterlite Tech also is up in trade. So a handful of losers. Balrampur Chini down 0.5%. Kaveri Seed is at 546, down 1%. Unitech penny stock, so it doesn't really matter. You've got Cox & Kings down 1/10. Chennai Petro also marginally lower in trade.
Okay, so starting off okay for the markets by and large. Metals too have bounced back today. Jyoti, what did you make of the move? I mean, the China reserve requirement rates being cut. More importantly, the impact that it has on metals, because almost everybody seemed to, or all global opinions seem to suggest that this could be the first of the many policy moves that China could do, and that could only support metal prices. They've come off, the stocks have come off quite rapidly. Do they give you an opportunity?
Yeah, so just on the metal space, we are underweight actually, because these stocks have had a good run, the metal prices have had a good run, and generally we are somewhere, we may not be at the peak, but we are definitely beyond the halfway stage of the rally. So to that extent, we always get cautious and we don't want to buy these metal stocks, closer to the peak of the cycle, because, no one calls the peak till the peak is behind us. But yeah, what you've seen is the Chinese bank cutting rates. You've seen Fed sounding a little more dovish. So that is the hope for this year. Last year, if you see, it was the first time after 2008 that aggregate central banks cut down their liquidity. Every year the liquidity with the central banks had, the size of the balance sheet was going up. Last year is the first year where the size of the balance sheet has actually shrunk on an aggregate basis. A lot of that has got driven by the Fed. So if that reverses this year, it will be good for emerging markets, it will be good for commodity markets, and that's really the trade for this year, I think.
All right. So while you're talking about commodities, would you also look at oil and gas? I mean, considering what's happening with regards to the crude oil prices. I mean, in the last few days, you've seen already a recovery in crude oil prices to the tune of 10% for Brent crude.
Yeah, crude is like a little more controlled trade because of the OPEC. I think there are two things which are playing there. One is, the Iran sanction and the fact that, some countries were given a concession for a few months. And if those concessions continue, then probably the market will be okay. But if they don't, then, we could see a bounce coming. My guess is crude will trade somewhere in, whatever, $50, $60 range, because US is trying to put pressure on, the producers so that they don't really go up beyond a point of time. The other thing on crude is, of course, the longer term, more and more everybody is worried that at some point crude will not be required because electric cars will become, more mainstream. And that may be a 5-year phenomenon, it may be a 10-year phenomenon, but it's something which is definitely coming.
Okay, fair call. Jyotivardhan, Jaipuria, on that note, take a moment to thank you for joining in today, this morning, and giving us your thoughts. Really appreciate your time, and happy investing in 2019. Well, from a large local voice to a large global voice as well, Johan, he's Chief Investment Officer at Bank of Singapore, joins us right now to talk about all things global, because frankly, global is where the action is. Johan, good having you. Good morning. Thanks so much for joining us at Bloomberg Quint India. What did you make of the Fed's comments, and do they give a consistent tailwind to markets? Because the last quarter has been one of extreme volatility. Will it sober down a bit more now?
I think it will do a little bit. I think the Fed has taken note of some of that volatility, although not that much. I think they also look at the macro, and they'll see that the inflation risk is a little bit lower than it might have been. There's a bit of slowing down in some of the numbers. The oil price, energy complex generally is a bit softer, so they've got cover. They can move a bit on the rhetoric, which they've done. And it comes at a time, like you mentioned, when sentiment was pretty bruised. So at least for the short term, I think this is something of a panacea, something of a just calm down a bit, let's see how things go. Later on, things might still change.
Johan, aside from Fed commentary, the other important event is the US and China trade wars, which nonetheless for China has had an impact. We've seen the economic slowdown and the numbers to prove that. And on the other hand, the US equity markets not doing a whole lot much, which again for Donald Trump doesn't do much, because the environment is such where you are seeing the pressure building up due to the US-China trade wars. Do you see that coming to a resolution anytime soon? Because that 90-day moratorium period is going to come to a close very shortly.
I don't think in the long term the US and the Chinese are close enough for us to expect a full-scale, if you like, resolution to the problem. In the short term, I think you can use a phrase something like, there's low-hanging fruit. The Chinese have made a lot of moves. They've introduced legislation. They can point to all of these things. The US might move a little bit on the tariffs. And that can give some comfort in the near term, maybe medium term, and sort of calm markets down. In the long run, the policy objectives of the two sides are quite far apart. I mean, the US essentially is trying to stop the Chinese from doing what they want to do, which is establish a really strong technological base. The US has issues with that. It has issues with the intellectual property rights and a variety of things which are not going to be solved in the short run. And whether that plays directly into firms and their earnings for the next few quarters, that remains to be seen. Longer run, it doesn't look to us as if there's an easy solution for a full-on, okay, that's it, no more talk about trade. That we don't see that.
Corporate earnings also seem to be under question. I mean, while we've seen positive growth numbers coming out from the US over the last few quarters, but that was also a result of the tax benefits that were given to them. So you may not see that coming into play in the coming few quarters. How does that shape up, and what kind of a sentimental impact does that have if you don't see these numbers pick up?
Well, I think that the market knows that not to expect a tax tailwind again for 2019. So the question is, how much of a discount do you take compared to 2018? And it looks like the right number is somewhere between 8 and 10% for the US. So you're moving from, let's say, just rounding up close to 20% for 2018, closer to 10% for 2019. That's what's roughly or should be in the price. So that's where the market has recalibrated itself. Or it should be anyway. We should not be surprised if there isn't, a tax windfall this year. So it's going to be, how does the market do? How do companies fare in terms of delivering relative to a recalibrated number to the left? Where the issue comes in is how much of a further haircut do you have to build in for trade war, if at all, and likewise if growth is a little bit softer, even though it doesn't look like it's going to be that soft. Where does this fit in? So it's much more to do with sort of how we go in the next few quarters, given some of the uncertainties, as opposed to sort of the tax cut which rolls off, which we know more or less is worth, give or take, like I say, 10% on the year.
If the Fed is not on a rate hike course, Johan, and work with an assumption that it is not, would that mean that the perceived threat of outflows from emerging markets would subside considerably, and 2019 might well turn out to be a year of investing in select emerging markets?
It could be a lot better than 2018. I think that the part of the flow out of emerging markets is, like you say, it's a risk-free rate argument. If US rates are so much higher than the hurdle rate for attracting capital, if you're an emerging market, just gets gradually more challenging. If we are indeed in a situation where the Fed does absolutely nothing, that helps the emerging markets. But even if they're pausing, even if we have, like our view is we can still see a hike or two or so this year and maybe even into next year, depending on growth numbers. That might not be catastrophic at all for emerging markets, because even then the speed has receded and the market has had time to adjust. And we do think there's probably an inherent softness maybe to the US dollar. Now keep in mind, when the dollar is strong and rates are going up, this is not great for EM. And at the same time, especially around Asia, you'll probably find a bit of resilience. If you look at the relative performance, Japanese and some of the other markets compared to the US for the last quarter, they actually outperformed because they're already quite cheap. So there's some bright spots for EM, for sure.
Okay, and if that's the scenario indeed, how does India stack up? Because, well, maybe because of the domestic flows looking so strong and saving the market at times of crucial falls, India hasn't fallen as much as some of the other EMs. The percentage returns for the year, maybe dollar terms may have looked wobbly, but in rupee terms, they have been positive as well for calendar year 18. How do you or any of the large global CIOs view India vis-a-vis the other emerging markets?
Well, we'd sort of say again, if you look at the broader picture, not necessarily too bad. I'd say, a certain element of defensiveness comes into play. Now, that I would say helps versus developed markets. It's not necessarily the best thing if you want to go full on in terms of taking risk, because then you probably want slightly higher beta market. But from the point of view of currency flow, from the point of view of where do you stand in terms of growth, again, I'd say at least constructive,
Jose, 2019 is going to be a year of which asset class, according to you? While we've been talking primarily about the equity asset class, will it be bonds that will also take that center stage? Will it be commodities? Because you're seeing a lot of flux in terms of what change in interest rates are doing to the commodities market as well.
I would say in the three that you've mentioned there, credit is not particularly appealing. I think 2019 is going to be a challenging year. Let's just get that straight. I mean, I think there's some possible relief in the shorter term, but I do think we're going to have a volatile year. We're seeing the Fed taking liquidity out of the system. We see the ECB possibly starting to do the same. And we've seen in the last quarter of 2018, as liquidity drains, volatility can be higher. So you need to be nimble. But the credit market looks at this point probably a lot more fully valued than stocks. So I think your best guess should be that equity markets could still be the one to deliver your returns very selectively. So you will have the opportunities. I think be more overweight equities at the right time. Fixed income, especially on the credit side, has not corrected particularly much. Again, selectively you can find value, but I think as an asset class, you'd probably find it struggling to outperform equities in 2019.
Johan, while we're talking about the equity markets and what's been happening in the US as well as the other emerging markets, and my colleague already spoke to you about it, but there is a lot of chatter that, for us as a market, for India as a market, the only thing that matters is that there isn't a sudden drop in the US equity markets. If it just about holds its place, then we are fine. Then we don't go anywhere. There is not too much of a carnage that we would see for our equity markets. Is that a view that you would hold as well, where we just need stability to hold on?
Well, it depends on how you view stability. If the US market is sort of drifting a little bit sideways, maybe even weakens, but it's a mild move, then I don't think there's any global market that necessarily has to suffer as a consequence. What you don't want to see is something more systemic. You don't want to see a really large move. You don't want to see sort of a broad risk off. Then what's happening in the US isn't necessarily the driver. It's essentially just a symptom of a broader malaise in the market, and then very few markets are going to really be able to hold up. What you can find in a fairly benign environment is the US can just underperform. There's no reason why the US should be the lead performer in a global market. And from that point of view, if wherever you are in Asia, if you're looking at China, if you're looking at Japan, if you're looking at India, then the fundamentals domestically will be driving, and not just sort of what's happening in the US. I mean, what you're talking about there is a slightly more extreme scenario where, okay, broadly, globally, you've got a risk problem, a risk tolerance issue with investors, and then the EM markets will suffer, but then you will also see the US go down. I don't think you should make that your base case.
Okay. Johan, the other question is the re-emergence of gold. Now, is this just a short-term phenomenon wherein gold is at $1,300 per troy ounce, or would you reckon that there will be some buying of the safe haven as well?
I have to say I'm slightly skeptical of the safe haven argument in the absence of a long-term and well-defined expectation for inflation to go up. If you look at the current scenario, and you look at sort of what happened in US bonds over the last 3-4 weeks, that was a flight to quality also. Makes sense because you can still have some yield. Gold pays you no yield, and if inflation is not going up, why would you own gold without any yield? And at the same time, you're not looking at price pressures. The rest of the commodity complex is telling you there isn't price pressure in the short term. So gold is a panic asset in that sense, and I don't think there's reason to panic. right now. So I would be, to be honest, somewhat on the skeptical side of a continued move in gold. You have it as a portfolio diversifier, fair enough, up to a point, but I would think that as we go into a period now, hopefully, the Fed's rhetoric, very solid payroll numbers on Friday, and combine that with at least some, at least optical progress in the trade talks. I think gold will have a challenge to maintain levels indefinitely, or at least medium to longer term.
Okay. My final question to you, Johan, what's the market that you're most bullish on? I'm presuming that you have a mandate to invest across markets. What is it that is looking the most attractive market right now?
I think, well, don't ask me what the view is. Ask me where the positioning is. That's put your money where your mouth is. Where's the skin in the game at the moment, and that's Asian equities, right? So, credit we prefer to be a little bit on the light side. Can be selective, a little bit skeptical, certainly of valuations on a relative basis. Anyway, in some of the developed space, Europe has got a few issues of its own. Just given how it's performed lately, doing well from a defensive point of view, but also from a valuation point of view, quite attractive. I'd say the general region would be Asia. There sits an overweight there.
Johan, we'll leave it at that. Thank you so much for taking the time out and being with us today and giving us your thoughts. Really appreciate your time.
Okay, thank you.
This is a view from the CIO of Bank of Singapore on all things global. By the way, while the global markets may have looked all okay, and it's not that we're not looking good, but we're off the highs of the day. Marginally at that, but off the highs of the day for sure. Also, it's a very tempered start compared to what maybe the US markets were indicating. But I draw the viewers' attention to the fact that the US markets were a lot more volatile than what our markets were last week as well. 3% down the other day, then 3.5% up. So they would show these exaggerated moves. We haven't quite shown exaggerated moves, but a bit of a reversal from the weakness that we'd seen.
In fact, we should see India VIX as well, because
come off in Friday's session, right?
Yeah, it was down I think about 4.5 to 5%, and looks like we're coming off a bit more, so closer to 0.5% right now, 16.07 at this point.
So, not a bad start. Let's see if we hold on to that or no. But corporate conversations coming up on the other side of the break. Naveen Jindal speaks and shrugs off raw material price concerns on the steel sector, but not in the power business. We get your conversation and then talk to country's largest animal healthcare company to understand how business is placed for 2019 and how the quarter could be. Manish Gupta of SeQuent Scientific would be talking to us as well.